the core sector growth, which has now come in for the 8 industries at 2.1%. If I look at the April to February figure, it's at 4.3%, absolutely flat year on year. It was also 4.3% the previous year. So let's go across to Madan Sabnavis of Care Ratings for more on this. Madan, what do you make of this figure that's come out? You know, it's 2.1% in February, so certainly much better than what we saw in January. Was January an aberration, or things are normalizing? Finance Minister Arun Jaitley did indicate that it's all thanks to that credit squeeze, a liquidity crunch that we saw since September that the economy has been hurting.
No, I think the number is definitely disappointing. So even though it's better than that of last month and was quite expected to be low even this month, but the fact remains that there is very limited activity which is going on the industrial front. And as the breakup of the core sector numbers show, that I think we are seeing traction in the areas of cement and steel. And I think coal has benefited this time by 7.3% more because of a low base effect. And also, of course, that the mining conditions were more favorable this particular month. But it goes back to saying that the leader in terms of industrial growth has still been the central government, the government expenditure on roads as well as affordable housing, the thrust which has been given. I think that's what's getting reflected out here. Yeah? So the number of 2.1% to my mind doesn't also augur too well for the IIP growth rate for this month, because normally it's in the region of not more than 1 to 1.5 times. So it could range anywhere between, say, 1.5 to 2.5% for the month of February. And we'll probably have to wait for next year before there can be any perceptible improvement in industrial production.
You're saying that this is also disappointing. Now, looking at the kind of information, the data points, the macros that have been coming out, ahead of the Monetary Policy Committee meeting scheduled for this week, decision to be announced on 4th, are you in the camp that believes that a 25 basis point rate cut is indeed coming? Many, of course, believe that the RBI should be bold and announce a 50 bips cut.
No, I think a rate cut can be taken for granted, because if you look at the language which was used in the earlier policy, was clearly directed towards the fact that growth is a major concern for the Indian economy, notwithstanding the fact that the chief variable which they're targeting, which is the inflation rate, is very much within the 4% comfort level. So I think that was one reason why the rate cut was announced, I would say a bit surprisingly last time. And carrying on with the same kind of logic of the growth still being fairly weak, as reflected by the IIP of last month as well as the core sector data for this month, I think there is a strong justification for a rate cut. Now, will it be more aggressive at 50 basis points? In my mind, I don't think that it'll be that aggressive, because we've already seen that lowering of interest rates has had impact on deposits, which are not growing because deposit rates are not being decreased by banks because of this liquidity crisis which we have today. It's essentially a phenomenon of deposits lagging credit. And therefore, we have a situation where banks are not lowering the deposit rates and the transmission has become a bit sticky. So I think the RBI will not gamble with a 50 basis points cut. I don't think that will really help too much. But a 25 basis point will send the right message. Okay,
that's Madan Sabnavis of Care Rating, convinced that a 25 bips rate cut is guaranteed later this week. And this is the February core sector data for 8 industries, improved from January, so at 2.1% against the 1.5% clocked in January, but still below what had become the new normal as far as core sector growth.